you want to make sure that you're investing it wisely in the right place. So there are several things that, like Warren Buffett said, no, you don't know anybody swimming naked till the tide goes out. The tide of interest rates went out. There was a lot of people swimming naked. So we reached this weird phenomenon where everything made sense on bridge. 80% loan to cost, not even loan to value. And then all of a sudden the tide went out and all those interest rates came out. So things that I look for are real stable things, so fixed rate debt.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth, one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
All right, welcome again to another episode of Spur Equity's Spur Your Wealth podcast. We are your hosts today, Param and Singh and Rav Singh from Spur Equity. So on our podcast, we aim to bring successful investors and experts and thought leaders to our podcast to share their story and secrets in investing so we can all stand to benefit from their experience. And so on today's episode, we have our dear friend and fellow investor, Trevor Thomson. He is based in Austin, Texas. But if you have ever gone to a multifamily event anywhere in the United States, you've probably either met him or seen Trevor. So he's everywhere. He is invested in 31 syndications, 20 as a limited partner and 11 as a general partner. And over the past few years, he's become extremely passionate about learning about real estate investing. His goal is to help over 1,000 people to reach financial independence through real estate investing. He's an avid learner, continues connecting with like-minded people. Like I said, he's at every meetup, every multifamily event. We see him all over the place. He's now an active sponsor, general partner, and he's also now with the firm Massive Capital as their VP of Investor Engagement. And so in that position, he's going to be creating a community for investors where they educate, inspire, and create a place for investors to feel part of an investor-friendly network. So really happy to have you, Trevor. Welcome to the Spur Your Wealth podcast.
I'm excited to be here. I've watched you guys start your podcast and went, man, I got to get on there. This is awesome. So it was great. And I know we've connected a lot together at different events and in San Antonio when I come down there. So super excited to be here.
Excellent. No, we're super happy to have you, man. So like I said, people have seen Trevor. If you've ever gone to a multifamily event or a meetup, he's there. He's I would say one of the most dedicated individuals when it comes to these events. And he's been going to these events quite some time and very, very active on social media as well. And so you've come across Trevor in some way, shape, or form, either personally or virtually. But our listeners that haven't, Trevor, I'd love to give you an opportunity here just to kind of give a little overview about your journey into and your background and journey into real estate.
So I have the world's strangest background. I'll do it really quickly. From Niagara Falls, Canada. Originally worked at age 13 for Ripley's Believe It or Not, all through high school. 18 years with Guinness World Records, which included lunch with Michael Jackson when we gave him a Lifetime Achievement Award. Then I wanted to move to the land of opportunity, America. So I came to Orlando. Strangely enough, opened a year-round haunted house. My partner in that deal was very successful in real estate. He did a lot of land deals and different types of things. So I got a little bit interested in it. Then I joined a company called I Fly Indoor Skydiving. The first team meeting, they gave all the employees a copy of Rich Dad, Poor Dad. I read the book like so many, and it touched me, but I also did what so many people did. I put it back on the shelf, and I kept working. And I always thought, I was afraid of single family. I didn't want the toilets, tenants, and trash. And then I went to the no time, no money excuse. And so for almost 20 years, I did nothing. And in the back of my mind, I was always interested and always thought I'm missing out. Never did anything. And then iFly did get purchased by a private equity group, so the no money excuse kind of went away. And I said, but
Hmm.
the tax man came, took about a third of what I earned from doing that. And I thought, there's a better way. I know it. You idiot. You didn't do it. Don't
Yeah.
let this year pass without doing it. Because so many of us, we know about it, but we stick on that little hamster wheel. We're on the Monopoly board going around collecting $200, but paying Rob, he owns Boardwalk. I know he does. And every time I go around the corner, I got to pay. And I just thought, why did I wait so long? And I had not
Yeah.
heard about real estate syndication. And the moment I heard about it, it was like my brain opened up and I went, I understand this business model. You take a little bit of money, you give it to experienced people who buy a business that's backed by a real asset, and you collect in the benefits. And I thought, how does the rest of the world not know about this? How am I in my mid 50s and I don't know about this? And then, of course, in my short time, I've done, as you mentioned, 20 passive investments, 11 as a sponsor. Once I got connected into it, there was no stopping me.
Well, that's amazing. Such a diverse background, coming from, first of all, different country, right? And then also coming from different fields into real estate. Love the fact that, you said you read that book. It probably spoke to you a little bit, but you were probably maybe scared or didn't know what to do. So it goes back, right, into where the book came from until maybe a life event happens. And for you, it was when your company got bought. So with the journey that you just kind of mentioned to us and our investors, tell us a little bit more into the fact that with the deals that you've done so far, and with the networking that you do that Param mentioned, you're going to all these meetings. Give us a little nuggets in regards to why do you attend some of these meetings that you attend? What do you get out of it? Is it important to do that, or is it important to just listen to podcasts, or is it important to just jump on a phone and talk to people? Why do we need to be out there to be, at this meetings, and what are you
Yeah.
personally getting
So,
out of it?
so again, as you mentioned before, I'm an obsessed learner. So part of me wanted to just go learn. And I'll be honest, the biggest lesson I've learned is who you give your money to is more important than where you put your money, what you do. The who is way more important than I ever realized at the beginning. And so I learned this as I started to connect with more people. And part of me was, I started out, I was busy, right? I had a very active full-time job. I was traveling the world, opening iFlies all over the world. I didn't have the time. So I was just looking to be passive. And then when COVID came, I was thinking I was going to leave my job, and COVID pushed me over the cliff, and they decided they were going to cut the
Mhm.
company by about 2/3. And so I switched gears. And then just the more I got into it and the more I went, I just kept learning and learning and learning. And it was really quite interesting. One of the first, because I started getting very active on social media. But there's a difference between being active and making genuine connections. So I want to make sure people understand that. You can post all the time, but what really makes a value is when you comment on somebody else's post, when you listen to something else and you learn, and then you decide to reshare something that adds value. So I started out at the very
Mhm.
beginning just trying to learn and then add more value, right? So when somebody puts a post about something, because you have to be very careful when you look at the who. We all look good on social media. Nobody posts the stuff that goes
Right.
wrong or anything.
Yep.
And so I really wanted to start to learn who people were, what they were doing. I'll never forget, I went to a meetup and I got in an elevator. The person recognized me, took a selfie. I didn't have a clue who they were. And I thought, I'm a celebrity. Not really, but,
Yes,
it
right.
was quite interesting. And so it's definitely paid off. What's paid off more than the volume are the individual connections. I know the last time we were at a meetup, we sat down and we had coffee and just got to know more
Sure.
about each other. Because again, the
Right.
who is super important. So to date, I've not made an investment in hospitality, but I know a couple of guys now in the who column. And when that time comes,
Right.
because I believe you should be diversified, I invest a lot in multifamily, but I've done retail, new build storage, a medical center. But you need to know who's the who when you're ready to make that switch. And you're not going to learn that just sitting at home, sitting on your own deals, doing different things. You're going to learn that by going places and meeting people.
Yeah, that's so true. And we were talking before we started recording how obviously we go to events as well, and we're part of a couple of masterminds as well. Mainly for that reason. Two reasons. One is you don't know everything, right? Like no one can know everything, and even if you're an expert in one particular area, by engaging and meeting other people, having new ways of thinking, and you learn. Like every podcast I listen to, or even when we do podcasts and we have guests like you on, there's always something to learn, right? And even when we go to these repeated events that are like, it's almost like the same agenda. Here's how you do multifamily syndication. Like, yeah, we know it, but when I go, there's always something new that I learn from that experience. The second thing is exactly what you said, the who. Now, Rav and I, we invest in a lot of different submarkets. We invest in a lot of different types of assets, but we do not claim to be the experts, right, in operating and running those assets. So we underwrite those, we select and we decide which ones to go to, but you're exactly right. It's the who that we're betting on, not necessarily the what. And I love this analogy of the racetrack, right? That the racetrack is the submarket, the horse is the multifamily complex, but the jockey is the operator that's going to, successfully kind of run that asset. And so you're almost always put your money on the jockey, right? Don't expect the horse to do it. Don't expect the racetrack to do it. It's the jockey. So betting on the operator. And so, again, we don't claim to be the experts, and we've all gone through our own journeys of varying degrees of success and things like that. But that's one of the things that have come shining, especially in the last year, right? When lots of folks have been facing challenges. You look at, some of your assets, and yes, some of them may not be doing as well as you thought they were, but the ones that are thriving, the ones that are surviving the storm and going to ride it out, it's because of the jockey. It's because of the people that you've partnered with. It's because of the operators. And so Rav and I are very, very clear about what our 2024 and beyond looks like, where we are going to partner with folks that really know what they're doing, really know, they know their racetrack, right? They know their horse really, really well. And so those are the people that we're going to partner with and bring the opportunities together and put opportunities together. So you're absolutely right. I mean, that's something I think lots of people are now realizing that, especially if they're facing challenges, like, why do I have a challenge here? When down the street, the department that I invested in is doing fine, right? And it's because of the operator.
Yeah, I love this. I
One
love
more
this.
bit
Go
I'd
ahead,
like
Trevor.
to add to it is quite interesting. My best investment to date. So I went to a lot. When I first started looking to invest, I went to everything, right? I joined everything. I went to everything. I watched people's deals. And I remember I went to a webinar where the sponsors talked about a deal that they had a problem on. And they explained the problem. They explained the things that they did to fix the problem. And it went from a possibility of loss of investor capital to returns, but not quite as good as promised, and their lessons learned.
Sure.
And I got on a Zoom call with somebody after that and said, I'm never going to invest with those guys. They don't know what they're doing. And I went, no, I'm investing with those guys. They've learned a hard lesson.
Right.
And I literally tripled my money in 20 months on my first investment with that group. Okay.
Yeah.
And again, I'm not a genius, but I like the honesty, right? It's really important to talk about the good, bad, and the ugly. Because if you only talk about the good, or if a deal seems too good to be true, my mama said, if it's too good to be true, it probably is. And she was a wise woman. And, so start to look at those types of things, how people are presenting themselves. How are they carrying when they're doing a podcast or an interview or a deals thing, and someone asks a question? Do they give a true, thoughtful answer? Or do they give we do conservative underwriting? I mean, who's ever invited you to a call and say, we're crazy and we think we're going to do really good, right? They always say that. So you've got to get down and really understand what's going on.
I would think, again, just this past year, we've all had challenges, right? We've all had challenges with cash flow. We've all had challenges with with inflation, with the lender market and all these, rates going crazy. And so you look at the communication that your sponsors are giving. Are they giving tough conversations, or are they laying it out very clearly that, hey, this is the reality, right? This is what this means for us. Are they being transparent in that communication, like you're saying? So are they sugarcoating it? Are they kicking the can down the road? Are they hoping for the best, right? And I think there's so much value in exactly what you said about a sponsor that's like, hey, here's where we didn't do something right in hindsight, but here's what we're doing to combat the challenges that we're facing head on, right? Like here are the steps that we're taking to as our fiduciary responsibility to save this asset and ride the storm out, right? I think those are the types of conversations that you want to be in, and you want to have, a sponsor reach out early and often, and just to give you the lay of the land that, hey, macroeconomics have shifted. And so here's what this means, and here's what we're going to do. So for example, like on our projects, we have a couple of projects in Phoenix, and they're doing great. They're riding the storm, as it were, right? But we've paused distributions, and we told the investors why we're pausing distributions, right? That we need to be in this kind of market. We need to make sure that our reserves are heavy, right, for unexpected costs and things like that, and making sure that we're doing conservative types of activities. Now, other folks, sort of early 2023, they were still dishing out distributions, and then you're doing 2 distributions, and all of a sudden it comes time for the 3rd distribution, and you're issuing a cash call. Well, those 2 don't resonate, right? Our stance was we'd rather pause distributions for a quarter or 2 or 3 than have to issue a cash call, right? Later in the year, right? If the climate still continued, some people did that where they were like, hey, let's keep the investors happy, still do distributions, they're happy, but then there's a cash call. Versus our strategy, we're like, hey, here we're gonna pause distributions. Here's your capital account. We still have good reserves in it. You can see that we have the money there, but we're gonna hold on to this until we ride this out a little bit. Mm-hmm. And so I think those are tough conversations to have, but investors are smart.
But necessary conversations.
Yeah, it's very necessary and to be transparent.
Yeah. So let's pivot a little bit and piggyback on this conversation is the fact that since we are talking about having a jockey being really important, you've done so many deals on an LP side, Trevor. Talk to us regarding what advice would you give to somebody, let's say like me, if I'm coming in first time looking at investing with your company or with somebody else's company, and I'm a limited partner. What is it that I should be looking at in today's market, given the fact that things are kind of tough right now? Maybe I do have some capital sitting on the side that I'd like to invest in. What should I be looking at, from a limited partner standpoint of view, to see if the deal makes sense or not?
First of all, the worst thing you can do is leave your money sitting on the sidelines, especially in a high inflationary market. But again, you want to make sure that you're investing it wisely in the right place. So there are several things that, like Warren Buffett said, no, you don't know anybody swimming naked till the tide goes out. Well, the tide of interest rates went out. There was a lot of people swimming naked. So we reached this weird phenomenon where everything made sense on bridge, 80% loan to cost, not even loan to value. And then all of a sudden the tide went out and all those interest rates came out. So things that I look for are real stable things. So fixed rate debt. Even if it's 6% debt and the deal still makes money, I would rather do that than sit there and go, okay, we're not going. So fixed rate debt became super important for people on deals. People that, again, know the area, right? So it's not like us, and I'm a good jockey, but I'm going to go race in the sand in Dubai, and I've never raced in sand. I may be a good jockey, but I've never raced in sand. I don't understand the market. So some real good market know-how. And definitely lately, and I mentioned it earlier that everybody says conservative, but truly conservative underwriting. I can remember when the world was changing and inflation was going up. I was going to these webinars and they were showing 10% rent bumps and 2% to cost bumps. And I'm like, I think it's the opposite right now. It's 10% rent
It
cost
should be the opposite.
cost and 2% rent bumps. So, looking for those types of things, right? Trying to understand what they are. And then again, how do they respond to your questions? Do they just blow you off with a cookie cutter answer, or do they truly try to understand what you're asking and give you an example of why or what or how or whatever it happens? At the end of the day, it is still our best guess, but I'd rather make my best guess with somebody that I'd be okay being in a relationship with for 5 years. Okay. My best guess for some guy I don't really know, and I really actually don't quite like him, is not who you want to give business to, right? This is definitely a relationship business, and you want to make sure, because right now the world has kind of gone crazy where you're not seeing any consistency. You're seeing, I was on this guy's team today, and then next month I'm on somebody else's team raising for a deal. Watch out for those people that are hopping around. Look for consistent partnerships. And I'm not saying they've had to have 10 deals go full cycle or do different things. I'm just looking for some consistency in a team, because real estate is a team sport. And you want to make sure, and again, it's easy to function as a team when you're winning and the tide is going your direction and you're swimming with the current. But the second you have to swim against the current, you want to make sure that the team is well balanced. Do they have somebody who is a strong asset manager? Do they have somebody with strong financial backgrounds? How are they with the banks? Are they well connected and do different things? And I know those are big terms, a little hard to know what my bank connection is, but that kind of just trying to get through those basic things. I think that's super important.
Yeah, absolutely. I think that's great advice, what you just kind of mentioned. And obviously that's coming from a seasoned pro who's invested in so many different deals. You've probably seen pluses and minuses. You've seen, all sorts of even markets, given the fact that you've been investing for so long. So we really appreciate the fact that, you're letting us know and letting our investors know on some of the things to look for as being an LP investor. So thank you very much, for sharing that. And what's 2024 looking like for you guys?
I think,
I know things are changing.
Unfortunately, there's going to be a lot of deals in trouble, which is not going to be all that good for current investors, but will be very good for future investors. When markets make a big shift, that's really when, everybody talks about the 2008 crash. The 2008 crash made more real estate millionaires than any other adjustment. So people that know what they're doing, they're in the right place at the right time. When there's blood in the streets, you should be buying, even if some of it's your blood. That's a big, very famous statement. So I think there's going to be a lot of buying opportunities for people that are looking for deals. But again, you're going to have to be super careful, right? Super careful on which deals you're getting and what you're doing. And I also like to advise people to have a little bit of a diversity in their portfolio. So diversity can be geographic. So staying, instead of having all your investments in one state, I definitely still am pro landlord friendly, pro business states. I'm not buying stuff in California, even though I got friends making money in California. I'm not going there. I just don't understand that market. And you want to look at some different asset classes, but I also want people to think of their investing like they're playing a baseball game. If you always go to bat thinking you're going to hit a home run, you are not going to win the baseball game. Who wins the baseball game is they can get a guy on first, they can get a guy on second, then they bring somebody in to get the home run and they get a grand slam. So some of my investments have only 10% preferred return, no upside. But for me, that was a nice safe one. So you want to get some singles and doubles, and then have some that maybe go for home runs, just to kind of balance yourself out. And you don't want to have 100% in multi-family. This is, again, you got to remember, I was in 20 deals, so it's a lot easier to get diversified. But you don't want to have 100% in one asset class. Or one community. And that worries me when I see some syndicators, we've got $2 billion worth of assets and it's all in one city. Oh, that scares me. It doesn't excite me, actually, that that city well. It actually kind of scares me, because what if there's a blip in a city?
Something happens, right?
And so when you're looking to invest, you want to look for things. And then the most important thing I want to make sure that listeners hear, that real estate is not a get-rich-quick deal. Real estate is a time use of your money. And so you want to make sure that you understand that it normally takes up to 5 years to double your money. But if you do, so I always tell people, invest 100,000, double to 2, then reinvest 2, it becomes 4, reinvest 4, it becomes 8, becomes 1.6 million. And in 25 years, it's $3.2 million on the same $100,000 investment, assuming you double, assuming you don't have tax implications. That is the true power of real estate, right? Staying in the game.
Yes.
So a lot of people saying, well, I pulled out and I'm sitting on the sidelines. The world is passing you by when you're on the sidelines. Okay, again, don't be foolish and just throw money out there. But your money sitting there, it's the compounding of your money, and the continued reinvestment creates true wealth for people. That $3.2 million is life-changing. $100,000 is really nice to have, but it's not life-changing, right? So real estate is long-term, and it's a game that your money moves slowly. But a real estate will always be a good value, will always appreciate. And even when you get these fluctuations and you got a couple of winners and losers, again, I think we're coming into a really good opportunity for people to start deploying cash again.
Well said.
Yeah, and I love the baseball analogy. It makes it real, because I think what we tend to do every time, as investors, as LPs, right? We're looking for the home run every single time. I think we're looking for the home. Oh, why would I invest in that? That's only X amount, right? They just kind of chalk it away and say, well, no, you didn't look at the risk profile, right? You're looking at a very, very predictable 10 to 15% return, with no real wild, crazy risks. Right. And so that's worth it to me, right? To take the risk off the table, that's worth it for somebody else. But I love the baseball analogy, because you're absolutely right. The teams that win the games are the ones that have the most diversification, that we can get a runner on first. We can advance runners and just kind of move the clock, and continue to make little strides. Don't assume that every time you're going to step up to the plate that we're shooting for the home run. You're probably going to get more outs that way, right?
Definitely.
I love that analogy, and we're starting to not starting to. We've adopted that philosophy for just the deals that we bring to the table. For example, like we had to pivot. When we're looking at the multifamily deals during the COVID days, where they were 2x, right? 2 to 3 to 4 to 5 years, we're 2xing. Everybody was shooting for that same 2x. When capital was cheap, when debt was cheap, that was achievable. Nowadays, you gotta that model is changing. And so for someone who is continuing to try to do that same cookie cutter approach in today's market, it may not pencil. It will not pencil. And so you got to pivot. And so one of the things that we did was, hey, let's take a lot of the risk off the table. We started doing industrial, which is very, very predictable, right? Because it's 10, 12, 20-year leases, and, rent bumps in each of the years. So it's a very, very predictable model, triple net, no expenses, we were hedging against inflation, for example, right? And so very predictable model. You're still making good returns, right? But you're not hitting those same returns that we were hitting it during COVID. But these are very risk averse types of assets, right? Where you have 10, 15, 20-year leases that from corporate guarantees and things like that. So you're not having to find, tenants every year, things like that. So as the markets evolve, our strategies have to pivot and adjust accordingly. And not everything is going to be a home run. Not everything is going to be, hey, I'm going to double your equity in 2-3 years. You might see a 20% annualized return is that double your equity in 5 years model. But if you look at it, there's plenty of kind of lower risk assets that may get you close to that. But again, you have to be in the right market. You got to be on the right horse, on the right jockey, with the right jockey. But certainly there's lots of opportunities, I think, as you're saying, in 2024. Yes, there's going to be a lot of trouble that we're going to hear about. That shouldn't scare us, because we were talking about it before we started recording this podcast, that even this week we heard a couple of new foreclosures that have happened in Texas, that from seasoned operators, honestly, that it just didn't work out. And I feel for them. I feel for the LPs that were involved that are going to potentially lose their equity. But we've over the last several months, we've heard about maybe half a dozen foreclosures that have happened. But think about thousands and thousands of deals that are still thriving or are still surviving or riding the storm. They're doing fine, or they will be fine as we cross this horizon. So I want investors to kind of think about that in the news, you will hear all of these foreclosures, all of these challenges, but there's plenty of projects that are doing fine. But anywhere where there are challenges, where somebody is forced to, let's say, sell short or sell before they wanted to, that's an opportunity for us, right? An opportunity for folks to actually purchase these. So if you do have money sitting on the sidelines, still keep your ear towards, hey, what are the opportunities that are out there? Because your money will do much more value to you if you're investing in one of those projects that are coming up for sale. So certainly, as Trevor said, money on the sidelines has never done anyone any good. So figure out where you want to put it, whether it's short term or long term. But again, if you want to take the risk out of the equation, there's plenty of lower risk opportunities out there that you can park your money in and still get a return, as opposed to just kind of sitting on the sidelines.
One more thing I'd like to make sure that people get too. You want to look at the structure of a deal. So my favorite type of deal is something that's a 70-30 split. So the investors are 70 and the sponsors are 30. I like a pref payment, a preferred payment, which means I get paid first. But opposite what many people market, I don't like the pref to be high. I want the general partners to start making money. So for me, I like something like a 70-30 split with a 7% pref. I can remember people sending me deals saying, well, it's a 12% pref. And I'm thinking, the sponsors are never going to make any money unless it's a home run. And if they lose interest, they lose interest. So I'd like to see, okay, we want to start making money after the 7% pref is satisfied. And then I don't mind a waterfall at the end. If we achieve greater than a 17, 18% IRR, the waterfall switches, because I want to invest in a win-win situation. I want to give my money to somebody who pays me first, but gets well rewarded for the home run. And a lot of people think, well, that's 50-50 split. That's terrible. And I'm like, baby, give me a 50-50 split, because you only can do that if you're giving me a 17 IRR, or if I'm on a storage deal. When they double my money, it goes to a 50-50 split. I'm like, double my money, baby. Right. That's why I'm here.
That's right.
And then it goes to a 50-50 split. Oh, please, I'm happy. And so a lot of investors don't think, right? They want to think about them winning, but everybody winning makes a good deal. Okay. When you make money first and the sponsors make money second and the sponsors get rewarded well for that home run, it's hard work to get those home runs. And I'm okay with that. So, look for people that create that kind of win-win environment. I really like that.
Sure. And, a lot of people don't understand what it takes to put a deal together, what it takes to run a deal, to manage a deal, to make sure that you're hitting the projections and the returns and the business plan. As you and I know, it does take a great amount of time for us to do that. And so, yeah, I agree with you. We look at the
Yeah.
same things, Trevor, and we want to make sure that if we are investing with other sponsors and other developers, that they're
Yeah.
compensated well, that they are in the deal, that they are going to be making money. Because if they're making money, then guess
Yeah,
what?
that's
We're making
exactly
money
right.
at
And
that point, right?
and
Because
there is a lot of
right,
risk
right,
putting. My first GP deal, I lost 75,000 hard. We couldn't get the deal done. Put a deposit down. It was non-refundable. My very first one. What a
yeah,
tough lesson. And everybody says,
and
"Why did you keep going?" Because I said, I know in the long run, right? You got one loser, but I'm going to get 10 winners. It's
yeah,
okay because I really
yeah,
want it, and you want to make sure. So again, looking at this the team, how do you fit in the team? Do you like the people? Is it a win-win situation? Those are all things that you need to look at. Don't be tantalized by, well, we've got a 12% pref. And then when you look at the underwriting and you look at they never hit 12%. I've seen people bragging about their 12% pref, and then on their little line chart, they didn't hit 8. And I'm like,
yeah,
what are you selling me? Like right then and there, it's the delete button, right? Because something doesn't line up.
exactly.
You're luring me in, hoping to get somebody that's not looking at the deal with this 12% number. And even your own sheet shows I'm never going to hit it unless you get the winner at sale.
Right. Right, right, right. Wow. Well, what a treat, Trevor. Thank you for
No,
sharing
it's
your
my
knowledge with
pleasure.
us. I know that, I know our investors are going to, look at this as very special episode because you're talking to them as from an investor mentality, from an investor side of view, right? Because a lot of the folks out there who are wanting to invest, who are maybe perhaps looking at a deal for the first time, they want knowledge, right? As we all know, knowledge is very important for us to execute, to take the next step. And so, yeah, what a treat. Thank you so much for sharing, your abundance, your knowledge that you have done on some of these deals, and what you've learned, what you wish you would have done differently. And so, anyways, I got a
I,
lot out of it.
I got one more for you,
Yeah.
Trevor, before we sign off, and then you can also, I'm sure people would want to connect with you directly, so you can share, how people can connect with you. But I got one more for you. So, obviously you're, like I said in the beginning, we've been talking about, how you make a presence. You come to these meetups, whether they're local in Austin or Houston or San Antonio, and anytime there's a multi-family event anywhere, we see you there. So we've obviously talked about the value of that, of community. If you want to learn, if you want to connect with people and learn from them, and find potential partners. But still, people go to these events sometimes, and they stay to the wall, right? Or they attended the event, but they really didn't attend the event. So tell us a little bit about some tips and tricks for folks that may not be as outgoing. They, once they come to the event, like, what do they need to do, right, to really get out there, to really meet people, share things about themselves. Like, what are some tips and tricks that you potentially have used to spark up conversation with people, just to kind of get the most out of
Yeah, so
attendance to
most
some of
people
these
will be
events?
surprised by this. I'm actually an introvert, and it's hard work for me to do it. I actually leave these
Yeah.
conferences exhausted. But the most important
Yeah.
thing you can do is what I say is in the next 5 minutes, I'm going to meet 5 new people. And then the friendliest of the 5 people, the person that actually gave me a genuine warm connection, I look for them talking to somebody else and walk up and say, "Hey, nice to see you again." And they always introduce who they're talking to. And so again, I try to be the friendliest person that they meet to when they meet with me. And then I look for people just like me that are afraid to engage. And I walk up to them and connect with them. And honestly, it's often always my best connection at the conference. So don't look for the people that are rock stars or important or doing things. Look for people that are interested in making a genuine connection, and then and tell them what you're doing. And if there's anybody, so I'm in Texas, is there anybody in the Texas market that you know that I could meet at this conference? So, and you'll be shocked at how much people go out of their way to help you. But if you don't ask for help, and if you stand in the sidelines, there's lots of other people to talk with, right? And so it's super important to do that. So, look for the people that are shy, and then meet 5 people, and whoever's the friendliest in those 5, get them to introduce you to somebody else, and then you just keep going that way. And by the time the 2 days are done, you're kind of shocked how many people you've met. But also take the time for genuine connections and ask about them first. Don't start talking about, hi, I'm Trevor and I'm looking for my first deal in Texas. Do you have any deals? I mean, who wants to talk to me? Yeah. Right? I'm Trevor. Where are you from? Oh, San Antonio. One day, oh, by the way, I'm going to put this in before this ends. One day you're going to bring me to a basketball game. And, but just that connection. So ask about them first, and it's amazing the connection you can make. And then I've had people that I've just met, and then like 3 days, I've been looking at you for 2 days. You got to go meet that guy over there. And I mean, looking for me for 2 days, what an honor. Like to introduce me to somebody who also lives in Texas or whatever. Right. It's amazing how good people really are.
What a great tip. Thank you. Yeah, that's great. That's amazing. We all do that, right? We all go to these conferences. Either we talk to just the friends that we have, people that we already know, or a lot of times we're reserved. We don't really want to be talking to other people. Yeah. It takes an effort to go meet people, to understand who they are. But that's why we're going to these conferences, is to meet people and to really trying to get to know other people. So
I know at Massive Capital, if a few of us go to an event, there's a rule that we can't have lunch or dinner with ourselves.
I love that.
So I've got to go you're not coming to dinner with me. You got to go to dinner with somebody else. Kind of an interesting way to do it.
That's great. That's great.
So Trevor, for folks that obviously want to learn more about you, maybe connect with you directly, what is the best way to connect with Trevor
the best
Thomson?
way is LinkedIn. You just got to remember the K, which by the way stands for Keith. I was never Keith, but that's what it stands for. So K, Trevor Thomson. Just connect with me, send me a note. You saw me on a podcast, especially the Spur Equity podcast, and always happy to connect. That's the easiest way to get to me.
Awesome. Well, this has been great. This is all the time we have, but Trevor, thank you for sharing your story, sharing your wisdom. So many great tips, so many great learnings today. So really thank you for sharing that with our listeners, and hopefully we can have you again on the Spur Your Wealth podcast and continue the conversation.
Thanks for having me. I love it.
Thank you.
Great. And thank you for tuning in to this episode of the Spur Your Wealth podcast. And again, we are Param Singh and Rav Singh from Spur Equity. So remember, your journey to financial freedom begins with both knowledge and action, where knowledge is power,
but action is superpower. So until next time, happy investing. Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at SpurEquity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@SpurEquity.com. Until next time, happy investing.